Today we are interviewing Director of Asia Equity Research at Morningstar, Loreintan. It's an honor to meet you. Let's get straight to the point. The timing of the first US interest rate cut has been delayed. The market is divided over whether there will be one cut or two. What is your opinion of this?
We do expect the U.S. Federal Reserve to cut interest rates in the second half of the year, whether that's September or maybe later in the fourth quarter. It will depend on obviously where the Fed senses inflation pressures to be coming in terms of the U.S. economy. In our view, we think there are some of the reasons that kept inflation high are those pressures should decline. Firstly, the consumers did benefit from the grants the support that was provided during the pandemic, and essentially, they're spending most of those savings off already. So we do expect that consumption or consumer spending pressures will start to materialize more evidently going forward. I think that will allow inflation pressures to continue to soften. That's one of the key reasons. We also expect some of the more momentary factors that led to the high inflation rates over the past few years, such as the supply side issues. The bottlenecks that came through with the pandemic, those are also beginning to ease. So those are the elements that will allow inflation to come down more quickly over the next 12 months. And that does give room and flexibility to the Fed as well as other central banks around the world to cut interest rates.
With the US presidential election approaching, political uncertainty in the stock market is increasing. What impact might this election have on the stock market?
One of the key things, obviously this is an election year for the US. I think for most markets, I think the gyrations will come from the rhetoric around tariffs on a global basis. So most of this is going to be targeted towards China. So I think where obviously this has creates more anxiety in terms of China shares more than that in other countries. So for example, in the past few months, we've seen the Biosecure Act come into place, and that's actually hit some of the Chinese contract manufacturing organizations. More so than those in other countries. So obviously China is a specific target here. And we've actually seen companies elsewhere like Samsung Biologics tend to benefit from that news. So it's not necessarily negative all around for Asia. There are some positive elements as well, some opportunities that might be created as a result of the anti-China stance or the anti-China export stance that we may see more of in the U.S. come to play. What this means, obviously, as we run up to the U.S. elections in November, we should anticipate a little bit more market volatility, given the geopolitics that will tend to ratchet up over the next few months.
U.S. stocks have been rising this year, led by AI stocks. How long do you foresee this AI wave lasting?
The U.S. stock market has been led for much of the past year by what is known as the Magnificent Seven. So going forward, I think in terms of where we think the U.S. market is headed, we've been telling investors to focus on the other companies that have not moved as much, but may still be benefiting from the same positives and are relatively cheap. They may be overlooked because of other factors that they have internally. So one of the examples we can talk of is in a technology space, for example, is Fortinet. Fortinet is trading around about a 20% discount to our fair value estimate. Obviously internally it's had to restructure some of its business elements. So we do think that the market, for example, has been a little bit cautious with this company. So we do see valuation laggards for specific cases. But in the case of, let's say, whether the Magnificent Seven will continue to propel things forward, that also will be quite specific to the company itself. If we talk about NVIDIA obviously still benefits from having a very strong AI platform that we think will continue to pull its growth forward. And really, as a market leader, we still quite like the company. We do think a lot of good news is already captured into its share price at this point in time. But having said that, we think there's room with everybody utilizing more AI in their technologies. Who benefits at the end of the day beyond NVIDIA and some of the leaders is questionable. We have a lot of, obviously there'll be much more competition coming up over the next few years as there are more market entrants here. We also do like the semiconductor names that we think could benefit from chip sales to this space. But having said that, the semiconductor business is a lot more than just AI. Obviously, it includes what's going on in the auto sector, for example, as well. But having said that, I think we still do like the chip companies as well. But we similarly have a preference for some of the laggards because of the fact that inventory cycles are improving for them on the whole. So that whether or not, so we do think there's still obviously more legs to run, but we do have a preference for some of the laggards in the technology space over some of the Magnificent Seven companies that have been leading the market.
What do you think will be the next trend sector to attract attention after the AI wave finished?
I think one of the general trends that we look at is as global interest rates start to come off, we think that's going to provide room for interest rate sensitive companies to start to outperform. And so these includes names that have lagged a bit because they may be, for example, dividend stocks that have to compete with the higher interest rates provided in deposits at the moment. So we do think that there is room for these companies to outperform as interest rates come down. So these includes REITs, for example, real estate investment trusts. It also includes, let's say, aerospace defense companies that pay attractive dividends, and also utilities as well. So particularly, I think where we expect let's say, one of the key sectors that we like presently in the U.S. market are the utilities, although they've also enjoyed quite a nice run-up in recent months. There's still some room in some of these defensive sectors to move up as the economic growth kind of slows in the U.S. And as interest rates come down, some of these dividend names we think will continue to perform and potentially outperform as well. For Asia, definitely we think there is room for the REITs to rise, and some of the high dividend paying stocks as well.
The Chinese and Hong Kong stock market have been struggled for the past 3 years. When do you expect them to rebound? I'm curious about your forecast.
In terms of valuation, definitely the China issues have lagged. This is obviously China, Hong Kong as a whole. And we think and we do like quite a few of the names in this space, particularly those that are more domestic oriented. So as you know, in China, the wealth effect has been negative because real estate prices have been coming down. The stock market has been somewhat soft, so people are just not spending, and consumer confidence is very low right now. So as a result of that, the broad share prices of consumer names in China have declined. So there's some very high quality companies in this space, including Maotai, Wuliangye, quite a few of some of the other Baijiu companies, and restaurant chains as well. So we do anticipate that, let's say, for example, real estate prices, this will still remain quite lackluster for the next 6 months, let's say, but we do anticipate things to start stabilizing at year end. So once this happens and we start to see the excess supply in real estate start to be absorbed, what we anticipate is that that should provide a floor to real estate prices and a little bit more confidence to come back into the consumer space as a result of that. Because once you get some floor to the real estate prices, and that should start to hopefully rise in 2025, a bit of a better data set will allow people to feel a little bit more confident in terms of where their wealth is in China. The other reason we like some of these domestic consumer names is because they're not they're not sensitive to the geopolitics that is going on globally between China and the US, for example. So these are purely domestic-centric companies. Of course, one of the key names here would be Tencent. We think there's still room for the company to monetize quite a few of its business segments, and it's still trading well below our fair value estimate of 700 Hong Kong dollars. So there are some, as I mentioned, what we call wide moat, highly or narrow moat rated companies that we think will outperform. Even some of the cyclical spaces, like obviously some of the better quality names in the real estate space are also trading very cheaply at the moment. We'd be a little bit cautious here. We'd be quite selective as to what companies to pick up here, but a lot of these are trading well below price to book. And so we think a lot of the downside is reflected in the higher quality real estate names. But do note that they'll be quite they will be up and down. And I think that until things are much firmer, there should still be some volatility in the share prices of these names. So we probably advocate buying whenever there's a pullback in companies like Kohli, China Resources Land, Songhai, for example.
Recently, trade conflicts between China and Western countries have been intensifying, such as EU tariffs on Chinese electric vehicles and US regulation on Chinese semiconductors. What impact might this have on the Chinese market?
I think a lot of risk is reflected in the China market because of geopolitics over the past, really since 2018, essentially. So it's come in waves, and we've noticed that, the discount that we're seeing to our fair value estimate has been around 13% since then. So whether or not it stays, I think that 13% to 10% may reflect what the market feels is a fair risk to apply to the Chinese companies because of geopolitics. But as I mentioned, I think from a domestic consumer space, there are companies that will continue to outperform. Case in point is like we've seen PDD do very well because of the growth that it's been able to carve for itself within the China domestic e-commerce space. And of course now with Temu, that's also driving growth for it from its operations in the US. But so there are still opportunities in China that will continue to do well regardless of geopolitics. And so we tend to prefer the companies there that we think have that growth potential on, and with exposure to sectors that are not sensitive to geopolitics and not necessarily to exports as well. So if we were to look at, let's say, the EV space, the electric vehicle space, even with the added gyrations from the EU tariffs recently on EVs, we still think the companies are going to be quite competitive. We do still like the pullback. On the pullback, we still like BYD. The bulk of the operations of some of these companies, the bulk of the sales are still very much focused in China. Obviously, there's a lot of competition that will come through, but we do anticipate some consolidation as well over time. So main thing is that the share prices do reflect that valuation upside.
What are foreign investors' views on the stagnant Korean stock market? How do you evaluate it?
In terms of the Korean market, I think we look at it the same way that we look at other markets in Asia. We still continue to prefer particular sectors probably over the broad market. And it's particularly, we think there's still obviously opportunities for large cap companies that are of high quality. For example, as I mentioned previously, we think there are laggards within the technology space. And if we look at, yes, TSMC has done particularly well and outperformed over the past quarter, and particularly over the past 6 to 9 months, let's say. There is room for other chip companies to go up. So, for example, Samsung Electronics is a company that we think has still got decent upside. And being a large cap name in Korea, I think a bit of outperformance by Samsung could actually pull up sentiment for the rest of the market as well. Having said that, I think overall, there is, as I mentioned, with global interest rates easing, there's room for some of the interest rate sensitive names to go up as well. So we would also look at some of these that may be, more attractively priced as good stocks to look at. So on the whole, I think if we look at Asia, this includes Korea, Asia as a whole, it's not overvalued, and I think because of that, there is definitely room for opportunities, and I think international investors do recognize that. But it's just picking the probably things people are looking at, picking specific names. We would recommend that people focus on specific value plays and companies definitely that have better upside potential.
Okay, thank you for sharing your insight today.